Thank you very much, Dr. Joel Ago. And I mean, I've been listening with keen interest since I joined, and Dr. Edmond has done very strong justice to you know to his topic, and it's really very inspiring to hear your story and all of that. And I'm hoping that members or participants in this session would have picked a thing or two. My name is David Larry Messon, and I've spent the last 16 years working with SMEs and startups as a venture builder. And I myself am an investor. I run a venture studio called First Founders and also own a community of about 1,500 early stage founders. I've raised over $15 million in capital for startups and SMEs in the last 10 years. So, following that experience in itself, I often say that when you run a business, it's important to know that at some point in your business, you are going to need capital. Oftentimes people say, man, but we need the capital very early I mean, when we start the business, we need capital and all of that. But I like to always say that if you're a serious minded person, you've got a fantastic idea, it's important that you put in your first savings, you put in your own capital in the business. And the reason for that is so that you can confidently, show to investors that you have put in your own money in a way that has proven the concept and has also validated the idea or the business model in itself before, and that you know that if they give you X amount of money, you will be able to scale the business. That being said, we need to note that the stages of building a business is sort of fragmented but connected. There's the building phase of your business, there's the scaling phase of your business, and there's the growth phase of your business, as much as we have what we call the maturity phase of your business. So when you start your business, that first phase of starting your business is the building phase of the business. And in that building phase of your business, there is a type of capital sourcing that you must apply to it, which means that when you are in that building phase, you are expected to know how to journey through raising capital for your business so that you are not going to meet the right person at the wrong time or the right investor at the wrong time. You know, when you have a business, it's important to prepare yourself to put together a solid foundation for that business, what I like to often call structure. You cannot go to an investor without having things like a pitch deck or a business plan. I mean, a business plan is even comprehensive, but it should have a pitch deck which shows to investor that you understand the business end to end, starting from the problem you want to solve to the solution that you have to the strategy you want to employ to execute the solution or deliver that solution to the customer, to presenting to them the market opportunity and the market size in what we call the total addressable market, the serviceable addressable market, and the serviceable obtainable market. The total addressable market shows the size of that industry that you are playing in. The serviceable addressable market shows the opportunity that market presents to you in terms of numbers, and the serviceable obtainable market shows the part of that market that you want to grab, and that way it shows that market clarity to your investors. And then it goes further into showing your financials, showing what your cost structure, your revenue streams, the team. But investors want to see that you have those documents in place. They want to see that you have a strong team, and they want to see that you have, a proof or a compelling product or a compelling proof of concept. So to raise funds first, For you want to raise fund, you need to have the pitch deck or the business plan. You need to have your financial model, and then you need to have your data room. Your data room shows to investors that you take record of everything that you do for the business. Now, starting from your CAC certificate, that will be a folder for it that you can title it legal. So everything legal goes into that folder. Another folder for the team, all the CVs that everybody submit goes into that folder. Your employment agreement with everybody that you employ goes into that folder. If you sign founders agreement, it goes into that folder. If you have a corporate governance, you put it in another folder to show to people, to all the investors that, hey, come, I document every single thing that goes in the business, and I understand the process of this business, and I adhere. I'll conform to structuring this business further and all of that. There are several other things that are in that data room that make sense. But then again, like I said, in the building phase of your business, how should you raise fund? The very first way to raise fund is to invest your personal savings in the business. To invest your personal savings in the business. Second is to bootstrap the business. But then in between your personal savings and bootstrapping that business is to drive value to your customer. Every business that attracts customers, when you don't have the physical value to present, shows that you have understood the value that you are presenting and the problem that it solves in such a way that the customer is eager to pay you even before you bring the solution. You need to bootstrap your business in work, and apart from apart from savings, bootstrapping is a combination of what I call family and friends, talking to your family and friends. I always tell people that, the stratum upon which you raise money begins from your cycle. If you look at your phone, can you create an immediate cycle of 10 people that can give you 1 million each to invest in your business? And that's 10 million. I did it with my business. My business is worth $6.7 million today, but I started with 0 naira. And that is a fact. What did I do? I looked into my cycle and I created a cycle of 10 people. And I said, hey, come, I'm about to run what's going to become one of the biggest venture studios in Africa. What do I want to do? I want to start investing in businesses and taking percentages in these businesses. At the end of 6 years, I will sell the equity that I own in these businesses, and the money I make from this will all share. You share your own cut from it. But this is the potential. If you look at my track record over the last 10 years, I've worked with over 250 businesses and I've helped them to raise money. I build them. I'm an experienced venture builder. So with this, I believe that we can all make money. Say, Larry, come on, you don't need to talk to me. We believe in you. We know your story now. Come on. Don't worry, just give me 2 weeks. I will send you 1 million. I said, send me an account where to send you 1 million. So one will say, give me 1 month, I will send you 1. And then I started getting all of that. I put all of that in an SPV, and the story is no longer the same. Just imagine the value of their 1 million naira today and the business. But then that is what I call under family and friends, right? Now, apart from raising that, and now these are fundraising pipelines in the building phase. If you notice, I did not say I went to meet VC or I went to meet an LP or I went to meet one big investor. No. In the beginning, the VCs and all of these guys will not listen to you. Your family and friends and you, they invest in your vision. Investors invest in your traction. When you translate the vision into a tractionable business, that is when you should go and meet investors and say, hey, come, I had a vision. I've moved from vision to traction. Give me money. You understand? To scale this traction, you get. And the traction story begins from the proof of concepts, having to validate with a few customers, and moving into what I call early customer acquisition in itself, acquiring customers who probably are not paying customers, but it shows that there is interest in your product, and then you move to early revenue and you move to proper revenue. And then you're now thinking about to scale the numbers of those who are in that base, who are doing business with you, or who your customers into bigger numbers. I would like to state very quickly, in this same phase, there is a way people look for customers that I like to change. Your customer, looking for customer is in what I call the 3C structure. We have the customer, we have the connector, and we have the collaborators. So when you want to market your business, think about it from this 3C structure. Who are my customers? Who can I collaborate to still reach more customers? Who are the people that can connect me to more customers? When you identify these 3 C's, it allows you to expand your customer base, expand your revenue base. But when you are thinking about it in that lateral manner, only by saying that, I'm looking for a customer, I have to do sponsor and all of that. No, it's about having a clear strategy to how you acquire customers, your collaborators, and your connectors. Because at the end of the day, a lot of people think that raising fund is about going to talk to people to collect money. But raising fund can actually be revenue into the business when you know how to maximize the potential of your people. When you understand all of this structure, it sort of gives you a soft landing to now becoming very compelling and becoming attractive for investors to want to do business. What are the elements that make your business attractive to an investor? It's when you have that structure I mentioned earlier, and when you have traction. When you know the stage in which your business is, you are knowing who to talk to. So in the building phase, your money, your customer, your bootstrapping, angel investors, grants, there are several grants out there today. Those are the things you should be looking for, because those things help you to create the initial impact your business needs to be able to attract the guys that will put in the main money. The second phase is when you get to the scaling stage. That's when you begin to talk to the VCs, you begin to talk to the DFIs, you begin to, you continue to move, you begin to go for debt finance. Don't go for debt until you are clear about your revenue stream. Then again, other things that we need to understand when it comes to raising money is that we must keep our eyes on ground, our ears on ground, and seek for opportunities and understand consumer behavior, understand the economics of the nation and how it is shaping customer behavior, so that can now allow you to juxtapose your value proposition with your customers and with investor interest. Now, your customer can be categorized into various spectrums. The customer one are the people you have employed. Those are your number one customer. People come and join your company because they buy into your company. If there is no buying, they won't work. Do you understand? So you must find people who buy into your company. You must buy people who buy from your company. You must find people who buy into your company. Those are the investors. When you understand how they are thinking, you are able to know how to get money from them. You must know who exactly your customer is. Sometimes you are producing or you are creating a solution that is only for a niche of your customer, but you don't know how to even communicate to them. And that way, you are not going to generate money. How many of you have seen Rolls-Royce doing advertisements on billboard? They don't, but Toyota can, because they want to reach everybody. But Rolls-Royce does not want to reach anybody. Lamborghini does not want to reach everybody. They have the way they communicate. Rolex will only sponsor some type of programs or events because they know where their money is. As a business owner, you must know where your money is. The people holding your money, you must know them. And it requires deep thinking, deep research. Same way, you must understand the investor that can invest in you, because sometimes you can be talking to the wrong investor. Investment, like what we call investment thesis. Every investor has an investment thesis. Before you talk to an investor, did you do your research to know if the investment thesis of that investor conforms with your own investment interest? So a lot of times people waste their time talking to that investor without knowing that the investor does not even have interest, or the investment philosophy of that person is not in alignment with their own interest area. You are wasting your time. So it's important that as a business person not to take much time, that you must know the stage in which you are building. You must understand where your revenue lies. You must know the type of investor you're talking to. And you must understand that you don't talk to VCs in your building phase. You bootstrap, you focus on revenue, you do family and friends, you look for grants in those first phase. And these are the people that can buy into your vision, because the other investors, they only buy into your traction, not your vision. I hope I make some sense at this point.
Um,
Just a very
I'm
short one. Thank you very much.